Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Last day, and what's the day? 21st. So Friday the 21st. Doesn't really jive, but you know, it's got those kind of vibes. I mean, massive overnight sell-off, and I think that's the big story which we will at least begin by addressing, and we'll pick it up from there. I'm Prashant Survi, Nigel with me, guys. Morning.
Hi, morning.
Morning, Nigel. Morning, Prashant. I guess I don't think the Bulls can say thank God it's Friday because of what's happened. I mean, my God, from the top, Nasdaq sliding 4%, all these stocks. And by the way, the ripples being felt across Asia. SoftBank shares fell 8%. I last checked, they're still down about 8-9%. So yeah, it's a wobbly-looking global picture.
Well, maybe the Bulls will say not be able to say, thank God it's Friday at the start of trade. But hopefully by the end of it, probably that could be the case because I mean, the gut is that maybe, in fact, India starts to outperform from here on, and I remain optimistic as well. And that's been the case, actually.
The anti-AI trade.
So you need days like this to prove the hype. How do you prove the hypothesis? So you've got to... Okay, all right. Let's just take a quick look at where we're at in terms of the picture, right? So just there are two opposing factors at play here. One, of course, is bearish. The other is bullish. I mean, the bearish factor, of course, is the U.S. market wobble. The bullish factor, of course, is the India-U.S. trade deal expectation. Frenzied expectation, actually. On social media, they were saying, well, is something coming tonight? Is something coming tomorrow? That kind of stuff. But it is what it is, right? And it's looking... so that's, at least for today, it's very, very near term. We're going into the weekend, etc. And typically, and yesterday when we were talking about the NVIDIA results and Hormuz was kind of sort of put out that big picture, the question was this, that whether the numbers are going to be enough to settle nerves. And it looks like perhaps they've not been able to settle nerves in any adequate kind of fashion. So that's where we are at right now. Let's just take a quick look at the price action now, right? US equity saw a dramatic reversal. And they paired earlier gains. From intraday highs, S&P was down 3.5%, Nasdaq down almost 4.6%. So these are big changes, almost like a violent sell-off. Now, NVIDIA had been up 5% in after-hours trading, but closed down 3%. Amazon was trading with a 2% gain. It ended with a 2.6% loss. Bitcoin, I mean, this crypto liquidation is another thing. As we've been saying, this is nothing but essentially from a stock market point of view, just a risk sentiment indicator. And it dropped below 86,000 levels. Of course, the psychologically important 90,000 gave way. And then quickly, Bitcoin prices fell. Robinhood was down 10%. And of course, if you look at the broader market, 10 out of 11 sectors ended the day lower. So, naturally, the trepidation, the anxiety will be whether this has got more to run on the downside. You're going into a weekend. And... it's entirely possible. You get one more day of kind of risk-off kind of sentiment, and then you've got to sort of come back to it on Monday morning. So that's the slightly confusing part. If you're trading per se, if you're investing and you're looking to be in it for the long term, it's a different matter. But of course, on a day-to-day basis, we're looking at more trading near-term price action. Walmart reported numbers, and we were sort of highlighting how Walmart, Target, Home Depot, all these will report. They're important to check the health of the U.S. consumer. And actually, standout quarter, Walmart rallied about 6%. We also had the September jobs report. So the actual number of job addition is double what the consensus was. So about 120,000 jobs added compared to about 51,000, which was the consensus. But the unemployment rate rose to about 4.4%. It's the highest in nearly 4 years. And on the back of it, if you look at where December interest rate cut odds by the Fed were before the jobs data, it was 32%. It jumped 9% to 41%. So, December rate cut odds now, 41%. Now, the 10-year Treasury yield lost 5 basis points to about 4% or so. Otherwise, in terms of macro markets, not very much else. So that's the picture. That's the price action and the sentiment out there as well. Now, Nifty yesterday at the day's high got to within 30 points of going back and reclaiming the September 2024 high, which was 26,277. So naturally on the upside, I mean, that's the level to capture, that's the level to grab. And of course, on the downside, you know, the 20-day is kind of trailing now. It's kind of been left far behind, but we'll still work with it because that's the big one. 25,835 for the Nifty. And for the Nifty Bank, the support stands at about 58,266. There are two things in favor of India as we start trade. This gush of liquidity which is coming into mutual funds, and mutual funds can't sit on cash, they've got to deploy. Second, of course, is this anti-AI bit. Maybe some truth to it, right? We're not being beneficiaries, and as air goes out of AI trade globally, I mean, people will look at other things to do, and perhaps India comes up in that sense. And of course, the third one is this India-US bit, which should happen. I mean, should happen, I would reckon, in November, but who knows? We've been waiting for it for a long time. GIFT Nifty will come up on your screen. I think we've seen a fair bit of recovery from the lows. We started with the 80-point cut on the GIFT Nifty. We're at about 10 points. F&O positioning stats, Nigel has walked across with that. Nigel, morning.
Well, I would prefer actually if the GIFT Nifty starts off much lower, 50, 80 points lower, that could give an entry opportunity actually. And, the bulls will say that all through the year, the entire global markets was parting on the AI trade. So no AI, no worry actually. That could be the sense in terms of the Indian market approach today. And if you just look at it, in the month of November, the Indian markets actually have been outperformers. Remember, all through the year, in fact, the Indian markets have been underperformers because we missed out on the AI theme, right? And all the other markets did well. But in November itself, we have actually outperformed. And that's good to see, right? Well, moving to the couple of other data points then. The Nifty IT index, that has been a rank underperformer. If you compare it to the Nifty, and if you even go ahead and compare it with the NASDAQ, well, just take a look at the stark underperformance that we have seen on the Nifty IT index. But in the last couple of trading sessions, tech has made its way back. And remember, tech was being ignored because it didn't have any big AI play. And technically as well in the last few trading sessions, it's conquered the 20 as well as the 200 DMA. And the bulls will feel quite good technically looking at IT index, which in fact has been relatively underowned. It's underperformed as well. So I think this is the index that you'll have to keep an eye out on. Can it recover, all the losses that we have seen? Crucial data point that we're going to be tracking. Well, in terms of flows, FIs, welcome back. Towards the end of the year, the FIs that have been selling on a month-to-month basis for the last many months, suddenly you're seeing a trickle of inflows. At least if they stop selling, that's good news in itself. And in the future space, well, they are net short. 88% of their positioning are on the short side. But yesterday as well, they covered close to around 2,000 contracts. They continue to remain aggressively net short, though, which actually could be a blessing in disguise. Moving to the options data, the PCR is gradually moving to the upper end of the range. Remember, at around 1.6 or thereabouts, 1.6, that's when you see that it's hit the upper end of the range. Currently, it's at around 1.44. But remember, we have expiry that will play out in the next 3 trading sessions. And with the market's net short, that could be the short covering bounce actually that you're looking at. And put writing, aggressive is what we've seen the last few days. 26,200, 26,100 puts aggressively written. And now the action on the call side has shifted around the 26,250 level with the premium at around 100 rupees. That brings us to the levels, right? In terms of a support going by the options data, you'll have to say first support level comes in at around 26,000 odd, which was a bit of a resistance. Then you're looking at the 20 DMA. So this range, in fact, will be very, very important that we protect in the near term. On the upside, going by the options data, 26,350 odd. I'll tell you what, the global market's in a bit of a tizzy, but don't be surprised if today we go ahead and we make a fresh all-time high. And for us to do that, the Nifty Bank will have to continue its good form. It's been moving very, very well. It's on its way to around 60,000 odd, and it's trading way above the technical levels. The globe, a little bit subdued, but I think India outperforms from here on.
Okay, all right. Well, that's what the picture is looking like. By the way, let me tell you, I've been looking at these Asian tech stock prices. There's no recovery whatsoever. It's really bleak out there. The South Korean market is down 3.5%. Japan is down over 2% right now. Hong Kong is down about 1.5%. Okay, so now it's down 2%. And the individual names that are part of this global AI story and tells you how closely correlated all it is. So SoftBank itself still down 9.5%. Tokyo Electron is down about 6%. Advantest, which makes all the testing systems for these semiconductors and these electronic systems, it's down 11%. And even in South Korea, SK Hynix, I mean, again, a manufacturer of semiconductor chips, down about 8-9%. So no recovery, and the fears continue. Despite the market reacting like this, let's hear out what the man himself said. This is NVIDIA CEO Jensen Huang rejecting talks of an AI bubble. He said that they're seeing something very different when he was speaking at the end of the NVIDIA earnings call. Let's just listen in to him.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, NVIDIA is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Okay, so now that commentary, it seemed to be working well, but it didn't last, not even 24 hours, and we've seen this shakeout come through. Let's play out some market reactions as well. Ed Yardeni, President Yardeni Research, says the issue of AI bubble and the quality of tech companies will continue to be a challenge for the market.
Well, I think this issue of AI bubble and how the GPU chips are depreciated and the quality of earnings of some of these tech companies will continue to be challenged. But I look at their revenues, and the revenues, you can't really doctor that, and the revenues kind of speak for themselves. Are absolutely awesome. And so I'm sort of in the camp that believes that this too shall pass, and I remain bullish on the market because I think overall earnings are pretty good. I mean, financials certainly have delivered great earnings. Industrials are doing extremely well.
Well, that's the fierce debate, right? There's Mr. Yardeni saying that you can't doctor these numbers. They look fantastic. But this is what's being, challenged by some sections of the market, including Michael Burry, the famed person who took that huge short bet in 2008. He's saying that because of the way they're accounting for depreciation, the numbers are looking a lot higher than what they really are. So it's a fierce debate. Here's one more voice, veteran hedge fund founder Ray Dalio, who thinks that market participants should look to diversify their portfolios.
A lot can go up before the bubble bursts. A bubble is an unsustained set of circumstances. It has unsustained amount of buying. Right. It has an unsustained amount of valuation. It has, and then there's something that pricks the bubble.
Is there a way to sustain this, though?
You can't look at, don't sell just because there's a bubble. Okay? Don't sell just because of bubble. But if you look at the correlations with the next 10 years' returns, when you are in that territory, you get very low returns.
Okay, and I think that is what Indian investors are watching out for. Whether it's a bubble or not is a different matter. But as long as global investors start to diversify away from the AI trade, perhaps India can be a beneficiary.
What is Mr. Dalio saying, though? Is there a bubble or no? He didn't say.
He's saying don't sell. Even if there's a bubble, don't sell.
No, but even if he's not putting his...
I don't think he's really called it out in that sense. That's the thing, Prashant, right? And that's what we've seen. Bubbles can go on for a long time. Who's to call the end of a bubble?
Yeah, 100%. There are famous case studies where you say, well, if you sold in, even in the 99 bubble, right? You sold 6 months earlier.
Yeah.
You would have missed the last 100%, 200, crazy number.
Yeah,
right?
absolutely.
But the point is, but my question was whether he's actually taking a side.
I don't understand. I think it was a very carefully hedged statement.
I think there is a nice market for a thought piece saying trading a bubble. Somebody will do it.
Let's welcome in William Lee. Let's pull him into the conversation. He usually looks at macroeconomic indicators and the economy at large. But William, let's start with that question. Is this a bubble or not? And if it is, then how close to the end of the party are we?
I think as the investors are listening to this program, and as an investor myself, I really don't care if it's a bubble or not. All I want to make sure of is that I am invested in the transformative technology that will transform production and consumption over the next 10 years. And that is what AI actually is. The real question to ask is, when will the cash flows start to come in from the end user? I, as a tremendous user of AI right now, I've been using every free AI model I can get my hands on. My company, the Milken Institute, is actually subscribed to a number of AI platforms, and we are bound by various codes of behavior to use them properly. But nevertheless, I, as a personal user, have not contributed a dime to any of the cash flow. So I think that is the question that a lot of investors are asking. Where is the ultimate cash flow coming from once we have all of the revenues from investment accounted for? And I think that is a good question to ask. Ray Dalio and like every other rich guy who's made it on past investment strategies sounds very smart when he says, when will you be looking at the returns over the next 5 years, 10 years, or what? And that horizon really is the key question I think all of our viewers have to ask themselves.
Yeah.
When do you want your return?
Absolutely. Your return horizon and obviously the price, right? I mean, I'm sure it's a great story. No one's denying that. But at what price are you buying a quote-unquote great story? But William, let's talk about stuff that you track, of course, far more closely, and that's the shape of the U.S. economy and the jobs. Finally, there's a jobs report, right? We got that September report. Now, the market, after reading through it, thinks that we won't get a December rate cut. What's your sense?
I am less certain about that because if people focused on that 4.4% and say, oh, the unemployment rate went up a little bit above the Fed's natural rate. Well, for me, that's really not the interesting part of the report. What was interesting was that there were downward revisions to prior months' data of about 20, 30,000, and the most of the growth jumped from the 70,000 or 50,000 that people expected came from government. And when you take into account these revisions, we're back to a very slow pace of job creation. And again, the sectors that created jobs were the usuals of healthcare and services that are not exactly the highest paying. So when you asked earlier about the shape of the consumer, Walmart has benefited tremendously because they have been able to discount to the low wage, low income consumer. And those are the companies that will do well because the U.S. consumer is not in good shape when you look at the growth of income, growth of employment, and where the growth of jobs are. It's not in the high paying, high wage sectors. They're in the lower paying service sectors.
All right, so William, let's get this clear. You're still expecting the rate cut or not? You're not expecting the rate cut. Is it in December?
If I were back in my job at Citi and I had to tell my clients what I think the Fed will do, I think they will pause. If I were on the FOMC, I'd be cutting by at least 50 basis points. So, and the reason for that is because I really take very seriously that slowdown in the labor market. And the kind of inflation pressures that we're worried about, they are the transitory price level jumps that come about from tariffs. So I think the balance of risks, to me, are certainly weighed toward cutting. But I think the caution and the lack of data that we've had over the last several months has allowed the FOMC to become even more cautious and probably overlook December.
Yeah. William, on a lighter note, put in that application. I think there is a seat coming up at the Fed, FOMC. I think it's a done deal.
I'm not well connected.
Sorry, what is that?
I'm not as well connected to be able to do that.
No, I think I'm just...
You need to be on social media, William. These days, everything happens on social media. Just need to put out a post.
Just tweet at them.
I'm counting on you guys.
But William, I'm weighing in for you. One vote, yeah.
But I think, obviously, I'm not saying right or wrong, right? Maybe it's correct, the right thing to do, 50 and not 25, and maybe the economy needs that support. We're not able to see that clearly at this point in time, and we'll figure out whether that comes out to be true. This Russia-Ukraine, I'm kind of lost the story there. Something still once again happening, right? Today's the 21st, which means, those sanctions were supposed to come today. But there's, once again, at least on the news front, movement, some new plan. What do you make of it, William?
For me, the story really rests on the Europeans. What will they be doing? And so far, there's a lot of hemming and hawing because I still see the Europeans buying energy from Russia. I still see a lot of promised spending that hasn't really shown up yet. So again, it's depending upon the U.S. to make up the difference until the Europeans get their act together. And as usual, the Europeans are taking their time to getting their act together militarily. So I'm afraid the conflict in Russia between Russia and Ukraine is going to really be even more extended than we thought in the past.
William, to round it off, when you spoke about that 50 basis points rate cut that you would have done if you were at the Fed, coupled with, I was just hearing your commentary. You sound a little cautious on the U.S. economy, which is a departure from the last 2-3 months that we've been speaking. You've been, very, very confident about growth. Is it because of jobs? Because all these AI guys, they've been cutting workforce left, right, and center in any case. And you mentioned that there's going to be some sort of an inflation play out because of tariffs.
The inflation play out, I think, is limited and to maybe a quarter point or half point. And you'll get maybe a monthly increase of slightly more than that on the CPI. But again, what the policy concern is where inflation is going to be over the next 1.5 to 2 years, because that's the lag for monetary policy. It's not the inflation today that we're worried about, and whether or not that inflation will persist at least according to financial markets, the way the pricing is done on the break-evens, it's not going to be there. So I think the Fed is really less worried about that, except to say that the lack of data allows them to be even more cautious on that front. And the fact that they say, well, we know the labor market's slowing, but we see consumers and everything else doing so well, especially investment in the AI. And I think that K-shaped economy where there's a huge gain on the part of the very, very wealthy, but most of the working people, working stiffs in the world are really hand to mouth. And I think that situation, the U.S. economy persists, and it's been a long-term story.
All right. We'll leave it there. William, always a great chat. Appreciate you coming on here on CNBC-TV18 and sort of talking us through some of this stuff. Thank you. Well, I think quickly running you through what the sort of interactions and chats we've got lined up on the program. So 8:35, we'll have the management of MedPlus to discuss their business outlook and the road ahead. 9 o'clock, we'll have the management of, we'll have Manik Taneja of Access Capital to talk about the current state of the AI boom and TCS sort of bringing in TPG for their data center business. I mean, they'd guided to bringing in a financial partner, and they've done that. 9:20, Harsha Upadhyay of Kotak Mahindra AMC will talk stocks markets. 9:35, the management of DLF to talk about their September quarter results. Metro Brands speaks to us about the sales momentum post GST cuts, etc. And of course, outlook for 27. And towards the end of the program, Lata in conversation with the Nomura economist Arudeep Nandi on volatile global markets and the impact of rupee, impact on rupee and growth.
All right, let's slip into a short break. Got a lot of stock-specific action track for you. Get at that in just a bit in our special Top 10 segment. We're looking at Godrej Properties, TCS, IRB Infra, Alchem Laboratories, VIP Industries, JSW Energy, and Reliance Industries. All of them react to positive news flow. On the flip side, Max Financial, AWL, Agribusiness, and Hindalco will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. It's still a tough picture across Asia. Markets are down anywhere between 2% to 3.5%. Hong Kong there lower by about 2%. Japan's also down over 2%. And, the South Korean markets, they are the worst hit. Let's pull up the GIFT Nifty and the implied open. What are we going to do? Look at that. Now, that is the anti-AI trade. See, guys, that's what I'm saying. We're only 16 points down, but that's on a lighter note. Let's see. Until yesterday, we were talking about taking out all-time highs, but today the global backdrop is so somber that the bulls are up against a bit of a task. What about individual stocks? Plenty of them making headlines this morning, so let's straight away get to the CNBC-TV18 list of top stocks to watch. Guys, morning and happy Friday to all. Nigel, let me start with you. There was a fire at Novelis' plant, is it?
Well, that's right, Surbhi. Yet again at the Oswego plant, there's been another fire. Remember, overnight we've seen a fire. We're still to get details with regard to the impact, but this is the third straight fire in a matter of 2 months. On September 16th, we did see a massive one. On October 10th, if I remember correctly, there was a smaller one out there. So this is the third such fire. We'll track the stock, and the stock will be, a little bit nervous on that. But just prayers to all those at that unit, and hopefully there are no casualties as well out there. We're waiting for details out there. But to tell you a little bit about the Oswego plant, the management had commented about this in their con call in the past month or so. They said they expected the unit to restart by December. Earlier, the street was working with the first quarter of the next calendar year. It's been pulled back a little bit to December. And they also said the cash flows will get hit in the second half of the year. The EBITDA losses will be to the tune of around $150 million odd. That's for this second half of the year. However, 70 to 80% of that will be covered via insurance in FY27. So now the problem is that deadline pushed back a little bit? I reached out to the company, and some source-based information that I got was that this fire was doused in around 2 hours. The earlier fire was doused in around 4 to around 5 hours. So hopefully it is not as bad, but we'll wait for clarity, going with red on this particular name. But hopping across to Vinny, a big deal was announced late last evening. TCS and TPG focus on data center. Tell us, Vinny, more about it.
Yes, good morning, Nigel. So TCS, obviously a good deal, a positive one. So green we are expecting here. Now talking about the deal, they've signed a pact where TPG and TCS will invest 18,000 crores in Hypervolt. What is Hypervolt? Hypervolt is a wholly owned subsidiary of TCS, which is mainly into creating these data centers. It's a special purpose vehicle that is created only for that. So this is going to be an AI related data center that they will be creating. Now, in terms of the deal, 18,000 crores, which I've mentioned. In that, how much is TPG going to invest? Up to 8,820 crore rupees. It's up to that amount. So what will be the investment that will be expected in terms of shareholding for TPG? It could range somewhere between 27.5% to 49%. So obviously, if they invest full 8,820 crores, then it will be 49% stake. Otherwise, it could be lower. Minimum is going to be around 27.5% for TPG in terms of shareholding, and accordingly, obviously, TCS's shareholding and investments will come in. Obviously, TCS, the investment that will come in is going to be through those compulsory convertible preference shares over the next few years. They have a lock-in period of 3 years as well, and TCS will be holding majority of the board as well, and TPG will be allowed 2 seats. We'll keep an eye out on this one. Green expected here.
Okay, all right. Thanks very much for that, Winnie. We'll keep an eye. Now, there is news with regards to Max Financial and, AWL, Adani Wilmar Agri as well. Vivek has got both. Vivek, morning.
Well, good morning. That's right. So both of these shares will remain in focus. You're expecting block deals in both of these names. And, we could anticipate that these block deals could likely happen in the block deal window itself, given the fact that the floor price for the block deals as per the term sheet we accessed last evening indicate that the discount is not more than 1%. So as far as Max Financials is concerned, Max Ventures is looking to sell close to 0.5% of equity. The total size of the block could be close to 270 crore. And it's just a 1% discount that they're offering. 1,675 per share is the floor price for this particular deal. Now, the other one on our radar is AWL Agri Commodities. Very interesting. It's a clean out trade. Remember, Adani Commodities will no longer hold any stake post today's block deal. Offer price is at 275 rupees a share. It's for 7% of the total equity. Important to note that while Adani Commodities held close to 20% stake in an off-market transaction, they actually offloaded close to 13% stake. So post today's block deal, they'll be left with nil, and this particular company expect the overhang to get away, clear away from this particular deal.
Right. Vivek, with regards to Max Finance, Max Ventures is the seller.
That's right. That's right. Max Ventures.
Isn't Max Ventures, I think there was a name change. It is Max Estates, right? Is it the same entity?
Well, as per the term sheet, they appear to have just around 0.46% stake. So it'll be interesting to note in the, details that come out, in the evening, exactly which entity has sold, because that is where the actual limit come out. But as per the term sheet, it is Max Ventures, 0.46% stake. It appears to be a residual stake that they held in Max Financial.
Yeah, I'm just wondering whether the money goes into, because Estates is also a listed company, but we'll see, and we'll try and clarify this one as we go along. Vivek, thanks very much. Godrej Properties is the next one we want to focus on. Sonal has got details. Sonal, morning.
Good morning, Prashant. Well, the company is in focus because they have made an acquisition, a land parcel in Nagpur, 75 acres of land parcel. And the development on this land will comprise plotted residential units and will offer an estimated saleable area of 1.7 million square feet. With this, they have been able to exceed their business development guidance of 20,000 crore rupees. And this is something which was expected because in first half itself, they had achieved 81% of their business development guidance of 20,000 crore rupees. And they had indicated they will meaningfully surpass it. And it has already happened in the month of November.
Okay, all right. Thanks a lot for that, Sonal. Well, let's focus on a couple of other names. Then Upasana is joining in to run us through some stocks in the news. Upasana, take it away.
Good morning. First up, let me start with IRB Infra. Now, the board has approved invitation to offer to the IRB InvIT Fund, which is likely to sell and transfer 1,700 crore Vadodara-Mumbai Expressway project. That's why the stock remains on our radar today. Next up is Alcam Laboratories. Now, company launches a probiotic, that is DSS, in India for gut health management. And what the company has indicated that the probiotic market in India is valued at 2,071 crore with a 5-year CAGR of 14%. Next up is VIP Industries. The stock is in focus on the back of sale of its non-core asset. The company to sell VIP House, which is located in Mumbai, to promoter entity that is Kemp & Co. for 40 crores. And lastly, JSW Energy also in focus as company gets approval for corporate insolvency resolution plan of Raigarh Champa Rail Infrastructure Private Limited. So all in all, we'll be watching out for all these stocks today.
Okay, all right. Thank you very much for that. Upasana, let's get back to Sonal. Reliance yesterday put out some clarification on how they're winding down their procurement of Russian crude and how the refineries will function from here on. Sonal, tell us the details.
Well, yes, they've gone ahead and said that now they will not be procuring Russian crude for processing in their SEZ refinery. All the cargoes that came till yesterday, that's the last one for that particular unit. They say any cargoes arriving on or after 20th of November will be processed at refinery in domestic tariff area only, and all operational activities incidental to oil supply transactions have been.
Oopsie.
I think we've just lost that line with Sonal. But that is the important clarification that Reliance did say that they will be complying with all international regulations, including, of course, the sanction of the latest Russian entities, saying that if there is any cargo that is arriving after the 21st, then it will be processed in the domestic tariff area refineries, not in the SEZ, so not for exports. So that's clarification coming in from Reliance Industries. Well, let's quickly recap our list of top stocks to watch. The ones that have positive news flow are Godrej Properties, TCS, IRB Infra, Alchem Laboratories, VIP Industries, JSW Energy and Reliance Industries. Stocks with negative news flow this morning would be Max Financial, AWL Agri and Hindalco. Okay, well, let's go across to Manisha now for the latest commodity cues of the morning. Manisha, I'm wondering what you're tracking, but I'm sure you're also tracking the fall in Bitcoin, right? What a decline in some of these cryptocurrencies along with the fall in tech stocks.
Oh, well, absolutely. When you look at this year, it clearly is divided in two halves when it comes to crypto. The first half is all about very strong U.S. push, institutions buying, corporates giving it to their clients, and banks facilitating trades as well. And that took the crypto to all-time highs. But second half is clearly a different story and continues to be like that. Yes, a lot of profit-taking continuing for Bitcoin, Ether, Solana, etc. So much so that we are in a bear territory for many of those. But also what we are seeing a decline in is a lot of commodities as well. If you look at the crude oil prices, well, we've seen a 4-week lows come in for this one. It's headed for a weekly decline. The U.S. crude inventory rise, China stockpiling crude, Ukraine president signaling a move to peace talks are some of the factors which have led to crude oil prices continuing to decline. Well, let me remind you that this is going to be a third straight year that we are looking at negative crude prices for the year as well. But the declines also have come in for many of these commodities. So whether it's gold, silver that has seen a decline, many of the base metal prices like zinc, copper, iron, and this is majorly because there is improved risk sentiment across equities. The US dollar index is trading on a firmer note, and markets almost believe that there is not going to be a rate cut in December. That is what is bothering many of these commodities.
Okay, all right. Thanks a lot for that, Manisha. Well, hopping across to Sudarshan, who's here to tell us some brokerages calls of the day. Hey, Sud.
Hi, good morning, Nigel. So Mahindra & Mahindra held Investor Day yesterday, and company has set ambitious targets for FY26 to 30. So organic growth over FY22 to 25 was 25%. Now going forward till FY30, they are targeting organic growth in the range of 15 to 40%. Today, brokerages have come out with the notes, and most of the brokerages maintain their positive stance. So CLSA has an outperform call. Target is 4,417. It says that company is confident on maintaining market leadership position on SUVs, tractors and LCVs. And I told you organic growth now they are seeing in the range of 15 to 40%. Group companies also have they have increased or upgraded tractor outlook to 9% CAGR from earlier target of 7% CAGR, and they have aggressive growth target for their growth gems. So in FY20, so M&M's share in the growth gems was around 8,000 crore. Now that has increased to 48,000 crore. That is M&M share, and total value of growth gems has increased to almost 56,000 crore. That is 7 times growth if you compare from FY20 level. Citi has a buy call. Target is 4,230 per share. It says it's surprised by the teaser that company has given for the two EV launches that it has planned for November 26-27. Earlier, there was a plan to launch one EV just ahead of Investor Day. Company has said not only one, they'll be launching two EVs. And Nomura maintains buy call. Target is 4,355 per share. It says valuations are still attractive as far as M&M is concerned. Morgan Stanley also maintains overweight, and target is 4,407 per share. Now coming to Vedanta, Nuvama has written a note. It maintains buy call and target is 686 per share. It says focus on demerger, delivery and deleveraging is on course to pay off for the company, and support will also come by tailwinds of commodity prices. It's expecting EBITDA to increase at a CAGR of 16% 15% over FY 25-28, and net debt, that is consolidated net debt, is likely to fall to 61,000 crore by FY 27 end.
All right. So two names, right? Vedanta and Mahindra. Sud.
Yeah, correct.
Okay, and we will, and Sud is going to come back and talk to us in more detail about individual targets within the Mahindra group of companies, right? A little later on the show. Thanks very much, Sud. Appreciate it. We'll take a quick commercial break here. We're going to come back in just a bit. Excerpts of our exclusive conversation with Anish Shah, Group CEO and Managing Director of the Mahindra Group, coming up.
Well, as Mahindra & Mahindra holds its Investor Day with 14 CEOs and business heads all under one roof, let's listen in to their 5-year plan.
We did mention to investors that we would look at one new area in the next 12 months with a very high bar. We had exactly the same slide that we put up a year ago. And at that point, we had said insurance is one area we would look at. We have gotten into insurance in a space where we feel we can create very meaningful value for our shareholders. And similarly, if we find a space we can create meaningful value, we will look at it. We do play in 70% of India's GDP growth over the next decade. And therefore, our current businesses have huge room to go. And you're seeing that room to grow with holidays. You're seeing that room to grow with many of our other businesses. We've also talked about organic growth. Organically, we've grown 25% a year for the last 5 years across the group, despite being in some tough industries as well. And we plan to grow 15 to 40% organically for the next 5 years across businesses.
I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously it will take a lot of time and attention, but scaling the core remains important.
Okay, all right. We'll keep getting you bites with regard to that conversation that we had with the Mahindra & Mahindra's top brass. Well, let's focus on another company then, MedPlus. We have with us Mr. Gangadi Madhukar Reddy, the MD and CEO at MedPlus Health Services, who joins us. Hi, Mr. Reddy. Good morning. Thanks a lot for joining in. Well, give us a few details then. You know, your SSG growth for the past quarter, I think it was low single digits. But for the year, you've been talking about high single digits. I think you were guiding for around 9 to 10%. Is the SSG growth likely to come in at the 9 to 10% mark for the year on the whole?
No, I said we'd actually start growing to that number by the year end.
Okay.
For the whole year, maybe not. I don't think it'll actually happen. You know, this year, because of our intense focus on private label, I think some of the SSG has been a little muted actually. This is an effect of last year's thing actually.
Okay.
Our private label.
So Mr. Reddy, you get to the 9 to 10% by quarter 4 is what you're telling us. It'll gradually start scaling up. Is that correct?
So it'll probably stay there. So it'll gradually start scaling up by Q4. High single digits is what I said, 9 to 10, not necessarily, but slightly lower. But the thing is, we will start seeing an improvement in our SSG as we go forward.
Okay, all right. And you mentioned that, the larger contribution from private labels is one of your focal points. I think the last number that we have is it's close to around 19% of GMV. How do you see this number scaling up? And if you could help us out with the impact on gross margins as well. What is the guidance? So private label as a contribution and gross margins. Please go ahead.
Sure. See, for every 1% increase in private label, you'll actually see a bump of around 0.2 to 0.3% overall gross margin. This is on the MRP sale normally. And obviously, we make more money on this than what we make on the brands. So the focus is to improve it as we go forward. But I think we probably will see, I wouldn't say a slowdown, but I would say the early adopters have come in. They've actually now shifted over from the brands to the private label. The rest will take some time to convert. The growth will be slightly slower, but it will be continuous. Given the fact that countries like US have got 90% generic. I see no reason why India should not get there over a period of time. It'll take a little while, but that's it'll be a slow but steady march towards that number eventually.
Mr. Reddy, good morning. Thanks very much for joining us, Prashant here. So I have a slightly different question, and this is actually I want to understand this. There's another company called Zota, right? Which is kind of in your same thing what you do broadly.
Not really. So we are a retailer, in the lines of let's say a Walgreens or a CVS. We sell all brands. Everything is available. We sell FMCG. We sell all the brands. We also have a significant portion of private label.
Right.
But we don't ever believe that, private label is going to be the only thing, but there's always going to be new drugs which will come out, drugs like Monjaro and the GLP-1 and all the other things out there. So if you restrict yourself to basically selling only your own brands, you'll never take advantage of the overall, set of products out there. No, we are not the same at all.
Yeah. Okay. No, I mean, in the sense that, they're also into, generics and private labels and that kind of stuff, right? So it's limited to that kind of point. I was just wondering. I was looking at talking to a few investors, and they were actually the feedback came from them that Zota. If you just look at what the stock has done, is just phenomenally well over the last couple of years. It's basically at a new high, and you're actually building out this solid, very large enterprise. And I think from the time that we started talking to you on the air, you always maintain it's like what you're trying to do is what we have in large pharmacy chains in the US. So what should we expect, sir, from an investor's point of view? I mean, I don't know how you answer that, but yeah, go on.
It's like this. I really don't want to comment on the market. True value will eventually basically get reflected out there. You can see from our EBITDA and all, it has been growing continuously. Our PAT has been growing continuously and all. And we've been adding stores continuously. The overall sales which we have is far, far higher than anyone else out there.
Correct.
So while the market can basically go this way, that way for a couple of quarters out there, I think the true thing will eventually come out. For us, the goal is to become the #1 pharmacy chain in the country. And that is by putting in as many stores as we can across the country. As we go there, benefits of scale and everything else will automatically accrue, and we will, start. Hopefully, it'll start getting reflected in the share price as we go forward.
But in terms of strategy, you're clear. You kind of are on the. There's no change in strategy or anything of that sort. This is essentially what you're building out.
Absolutely not.
And that continues.
Absolutely not.
Yeah.
So today we have a gross margin of around 25%. That gives us the freedom to actually expand through franchisee stores. There's enough money for us, enough for the franchisee who actually comes in. The fact that we are able to give something like 30% overall. I'm talking about both FMCG and pharmacy by volume comes from the MedPlus brand. Means that a franchisee who actually comes in to take a store has something unique to actually sell. And not just that, we sell our products at a price which is way less than the market. So which means he'll also have a chance to basically beat the competitors around. So great value proposition for a franchisee to come. We have the brand and the basically ability to actually start growing and building the back end. I think going forward, you will see us basically focusing more on growth through franchisee, and that will be a far faster growth.
Okay, all right, Mr. Reddy, we'll leave it on that note for today. Thank you very much for joining in, and good luck for the rest of the year. We'll take a break on that note, come back on the other side. We'll have our technical experts joining in. Also, Siddharth Khemka of Motilal Oswal will be with us to discuss some fundamental stock ideas. Welcome back. As promised, let's get that conversation going with Siddharth Khemka of Motilal Oswal Financial Services. Sid, good morning and happy Friday to you. So let's talk TCS, putting a lot of money to work, getting in TPG. And this is what we're seeing globally as well, right? That's what a lot of the global giants are doing, getting private equity to fund this rapid growth of AI and data centers. Your thoughts earlier when the company announced its own investment, at the time of results, there was some issue and market was wondering whether this is unrelated, etc. How are you looking at it?
Good morning. Happy Friday to you as well, Sukhbi. I think, yes, I think the investors were looking for some of these IT companies that are generating a lot of cash and they're looking for the next phase of growth where they will find. And as you rightly said, globally, AI is the space to be in. AI data centers, I think. At the time of results, they did announce investments, capex into the data centers, and now the global PE fund PPG to support its data center business. So I think that only adds to the credibility that investors would like some of these large Indian tech companies which are generating a lot of cash flows to diversify into the future or new age businesses for sure. So we are looking at it very positively. Again, as I said, there was a big investment announcement, and now with TPG coming in, they will share a portion of it. And I think the shareholding has also been decided between both the entities, so a JV will be formed. But nonetheless, that's a positive step in the right direction in future growth business.
So it's a buy, TCS?
TCS is definitely a buy for us, more from a long-term perspective. As I said, things are falling in place, and here we see a good recovery for IT companies. Although within the IT space, our top tier one preferred pick is HCL Tech, given its more diversified business model, more business coming in from the digital side of the business.
Okay. The other interesting event of the day is going to be these numbers that we get from Grow, right? Finally, we'll get quarterly financial performance. So much is going on. What is your sense? Okay, let's not talk about technically what's happening with the stock and whether there was a short squeeze and all. Let's leave that aside. Let's talk fundamentals. I mean, how do you rank the performance, and what sort of a growth run rate and margins will Grow have to show to keep investor faith intact at a price of 150, 160 where it's trading right now?
So, unfortunately, Surbi, we were one of the investment bankers, so I think I should not talk about it right now.
Okay. All right. We'll let that pass then. Any new stocks on your radar? Anything that comes to mind?
Yes. So I think a lot of stocks that are coming, especially the Mahindra Group, they have been announcing a lot of long-term vision and plans. That is something that we are looking at today morning. Apart from that, I would say NBFC is something which is doing very well. We hosted the management of Poonawalla FinCorp, the MD and CEO, for a meeting with some of our investors to discuss the company's future trajectory, as well as what is the progress that has been achieved in the past 1 year of the new leadership. So what we see is that continuously the company is delivering on its stated ambition of being a digitally enabled multi-product, high ROE lending franchisee. We believe that Poonawalla FinCorp is well positioned to sustain its 35 to 40% AUM CAGR guidance that it has given with an improving profitability. The company is also targeting to achieve its guided ROAs of 3.5% by June of 2028, which only goes on to say that apart from growth, profitability, as well as return ratios, they are on track to achieve all of them pretty comfortably. Valuation-wise also, I think with that kind of growth, we see a lot of comfort in valuation. So we have a buy rating on Poonawalla FinCorp with a target price of 600.
Okay. All right, Siddharth, thank you very much for that. We do have to take a quick break. Come back on the other side. We'll have the pre-opening rates. And, of course, we have to get our technical guests and give you some technical perspective for today's action. And then Axis Capital's Manik Taneja joins in. We discuss IT full throttle, the AI boom, some of the stocks that are beneficiaries here in India, and, of course, TCS, looking at this, a big splash in data centers itself.
Well, will the global scene make a difference is the question. And let's get Siddharth Rai of Stockbox Technologies and Sudeep Shah of SBI Securities in this Friday morning to answer that question. And of course, help you with what you should do. If you're trading this market. Gentlemen, great to have both of you here. Sudeep, you go first. How's the setup looking?
Good morning, Prashant. Prashant, see, yesterday we have given a close above that all-important level of 26,100, which the markets have been resisting for quite a while in the last 1 month. Several failed attempts there, and finally yesterday we have seen that breakout, led by large caps, especially IT, banking. So what we feel is that the setup from a Nifty perspective looks stable. Even if we get some kind of a softer opening today, dips should be utilized to buy. And overall now, we feel 26,050, 26,080 zone will act as an important support. On the upside, we feel the levels of 26,400, 26,600 could be visible in the next 4 to 6 trading sessions. And coming to Bank Nifty also, 58,800, 58,600 now becomes an important support. Until this zones are guarded, we may see an upside up to 60,000, 60,300 levels. The only disconnect here, Prashant, is that we are not seeing that follow-up moves in Nifty small cap. As we see a ratio chart of Nifty small cap compared to Nifty, that is hitting lower lows. So the only thing is that the broader markets are not performing. But from a Nifty perspective, these are the key levels, 26,050 as well as 58,600 on Bank Nifty.
Okay, got it. Sudeep, let's go across to Sid. Sid, what do you make of the trading action? Global markets in a bit of a dizzy. I think the bulls out here will say, "Apna number aa gaya." It's our time has come. What do you think, sir?
Hi, Najal. Good morning, and thank you for having me on the show, first of all. See, Najal, if we talk about Nifty, the past couple of sessions have been very good for Nifty, definitely. And since we also saw closing about 26,100 yesterday, just like Sudeep said, definitely I do think that we'll probably be taking over the all-time highs in very soon, probably in the next couple of sessions. But having said that, Nigel, right now the risk rewards for taking a fresh long position do not seem to be very favorable for the index, because for one reason, the global markets have not been very favorable, not been very supportive. The PCR is overbought in Nifty. So the better way to approach the index right now would be to take the buy on dips approach. Just like Sudeep said, a good support is around 26,100, 26,050, those regions. Once Nifty comes down around those levels, we can start accumulating the index again, because on a positional basis, Nifty looks definitely very good, and it'll be pretty favorable for us to say that Nifty will be hitting the all-time highs in the next couple of sessions.
Okay, got it. All right. Siddharth, you go first then. Tell us about your top picks.
Yeah, definitely, Nigel. See, two stocks, both of these we have to buy. The first one on my radar is Dabur. See, it is only one of the very few FMCG counters which has held on to its supports very nicely. And we also saw a breakout coming in yesterday's session in this counter. So Dabur looks very good. It can be bought. Yesterday's closing was around 525. The stock can be bought. We'll keep the stop loss at 518. And our targets being the first target 535, the second target being 540. The second stock is Mazagon Dock. See, we've started seeing a turnaround with this counter probably in the last 10-12 sessions. Yesterday, there was a very nice breakout, so a fresh momentum is building up. Again, Mazagon Dock can be bought here. The spot is trading around 2830-ish right now. We can buy it here. The stop loss will be at 2799, and our targets being the first target 2885 and the second target 2910.
Okay, Sudeep, what about you?
Nigel, two stocks from my side too. The first one is from the insurance space. ICICI Lombard closed at around 2035 yesterday. This stock has given a decent breakout on weekly charts backed by volumes. And what we are seeing is that this is outperforming most of its insurance peers. And here we feel that 2000 could act as a decent stop loss, and on the upside levels of 2100 can be achievable. The second stock is Mahindra & Mahindra. Another large cap here. The stock is hitting newer highs, has been seeing good momentum and outperforming even within the auto space. So what we feel is that this stock could do 38.50 in the coming few weeks. And on the downside, the stop loss could be 36.50.
Okay, all right. Thank you very much, gentlemen, for all of those trading calls. Well, the pre-open session continues. Let's see what TCS is doing. The market's down about 80%. Sorry, beg your pardon, 80 points. TCS, which is a stock in focus this morning, seems flat on my screen. Yeah, actually, we don't have a rate as yet, so we'll have to wait for it. Manik Taneja joins in. He tracks the IT space very, very carefully at Axis Capital, and there's so much to discuss. Manik, thank you for being with us this Friday morning. So there's an overall AI debate that's raging around the world, whether this is a bubble bursting or not. But before we get to that, I mean, let's talk about what TCS has done. They're really showing their commitment, right? And now they've got a big partner in the form of TPG. How do you view this 18,000 crore rupee investment that was announced in data centers yesterday?
No, I think this basically just marks progress on the initiative that was called out with the prior quarter's numbers in terms of TCS looking to bring in an external partner either in the form of equity and debt. And thereby this announcement essentially does confirm progress on that front. And I would say this is a long gestation project on TCS's behalf. And otherwise, does it have any immediate bearing on the stock? I would say presumably.
Not immediate, but if we talk strategic direction, I mean, does it move the needle at all? Because one thing that Indian IT services companies have been called out for is lack of innovation, lack of really stepping up R&D in the next, cutting edge areas of tomorrow. So I'm not saying 1-2 quarters, it obviously doesn't change anything. But if these investments continue and if they start committing more, if the company starts committing more capital towards either data centers or anything else on the AI front, I mean, how should it be viewed?
Certainly a move in the right direction. The only thing that I would say is that TCS has been very categorical in terms of saying that they will limit the capital commitments from the cash flows of the services business in any of these initiatives. And even if you have to do some rough maths, the kind of cash flow that TCS generates and the commitment that they have with regards to return to shareholders, they will still have some balance cash flow to commit to these initiatives. And this is something that will play out over a 5 to 7 year period. The bulk of the value for TCS still comes in from the services business, and thereby I would just say that this is just a progress in the right direction, but does not move the needle in the near term.
Manik, correct me if I'm wrong, but I think your large cap preference is more with Infosys and Wipro.
Yes.
Over TCS. Explain why?
So that's been the call for a fairly long amount of time. The reason for not preferring TCS has been both some of the portfolio aspects and the internal changes at the company, because of which TCS has been struggling on relative revenue growth compared to peers. We've seen them lose out in certain vendor consolidation exercises compared to competition. And I would say that will keep their growth performance in check compared to competition, even for the foreseeable future. So that's been the reason for not preferring TCS to other tier 1 companies over the course of last, I would now say 24 to 36 months.
All right. Hi, Manik. Good morning. Good to see you in. What about Emphasis? It's going to go the Coforge way. The large PE in there has gradually started selling. Everyone feared, right, when that happened in Coforge. And all of it got lapped up at half the price, at 1/3 of the price. And the stock just continued as growth continued. Do you believe this is an overhang, or do you think that, things will progress in the similar direction and prospects will come?
So Nigel, the difference between a Coforge and Emphasis, at least when the PE was selling, was that Coforge continued with their growth momentum. In case of Emphasis, they've struggled through a majority part of the last 36 months. A combination of high exposure to BFS, high concentration of top 10 clients, some headwinds from the cyclicity of the mortgage business exposure, all of which, in my view, are turning around. And just like some of these portfolio issues were a drag on growth through the course of last 3 years, they might end up being tailwinds on growth on a go-forward basis. And that's the reason why we had upgraded Emphasis to our top pick in March of this year and still retain that. So I would presume that as long as the business performance continues to chug along well, investors will lap up the liquidity that comes in from PE sale.
Manik, no, absolutely. I'm going to sort of segue out maybe just a little bit. This is the persistent management on CNBC network. addressing, of course, the big question of our times right now, right? I mean, which is AI. I mean, the question here in India is what AI will do to Indian IT services companies. The question in the US, of course, is whether it's gone too far, at least in terms of valuations and the big explosion of interest in that space. So here's the persistent management.
Bubble that we all are talking about is about the valuations. I don't think it is about the AI part being real. I definitely think the AI momentum is real. We are in a very early innings of this whole, percolation of AI into enterprises, into the way we do business, and so on. When we look at our customers, they have all been doing proof of concept. Some of them are going big. So this is going to be a multi-quarter, multi-year journey. So it's not about the market, the addressable market not being there. Now, as far as the valuations are concerned, markets are the best judge. Whether the NVIDIA valuation or other valuations are the right valuations at this point in time or not, we'll let that be the market, place. Now, as far as AI and the entire reskilling is concerned, obviously, the way generative AI and AI at large work, and they are getting infused into every part of business that we do, whether we are a tech services firm, whether you are an enterprise in healthcare, in financial services, and so on. So the amount of reskilling, the workforce transformation, that is real.
Yeah, it's real. Sometimes, of course, with markets, as they say, right? I mean, what is worth doing is worth overdoing, and markets have their own do their own thing. But that's the persistent CEO earlier. Manik, we'll leave it there. Thank you very much for joining us. Thank you very much for sort of being here on CNBC-TV18 this morning. Just a quick look at the opening first kind of rates as they will start to come in, and I think we're about a minute away to that. So, it's a broad sell-off last overnight. The pre-open has ended with about an 80-odd point cut, 26,100. So it's basically back to that kind of, that number which the market was struggling to get out of. Yesterday, of course, in that big rush, took that level out, got to within 30 points of a new high. So we'll see how it goes. So, optimism as far as India is concerned, but globally there is a bit of a red on the screen. So we'll have to see how much of that matters. A third lower, 26,120 is where we're at. The Nifty Bank is starting about a third of a percent lower as well, 59,130. The small cap index is down 0.16%. The mid cap index will come up on your screen. And there as well, there's about 200 point cut. That's about a third of a percent cut there, 0.4% actually on the mid cap index. As well. So almost 100 points now. So exactly at about 26,100. The Nifty heat map will give you a sense of where we are opening up as far as the 50 stocks go, and then we'll pick it up from there. It's just about 4 or 5 names in the green, and TCS after that TPG deal is the top gainer. Otherwise, I mean, stuff opening on the downside. Hindalco, Nigel was telling us about the Novalco news and Novelis news, beg your pardon. And actually just 46 odd names in the red at the word go. Surbhi.
Okay, indeed, Hindalco is down about 3%, making it the poorest performing stock on the Nifty right now. There's a whole lot of red on the screen. And it's across the board, really. Shriram Finance, ICICI Bank, Axis Bank, Bajaj Finance, SBI. So all of your financial space is weak. Bank Nifty is down about 0.4%. There's HCL Tech on the downside, I can see. There are some consumer names like Eternal, Tata Consumer on the lower side. Reliance itself is lower by about 0.5%. Yesterday, remember, Reliance was a great support for the market. It's starting about 0.5% lower. On the upside, there's Mahindra and Mahindra. Almost all brokerage notes that I saw were calling for levels, well over 4,000, ranging from 4,200 to 4,400 in some cases on that stock. So that's doing pretty well. A little bit of green on Asian Paints. TCS barely positive, just about 0.3, 0.4% up. And then it just starts fizzling out. So right now, this is a down morning. There's no taking away from that. 80 points lower. But the question is, if this dip gets bought and if we can have a green close, that'll be some Friday, Nigel.
Yeah, that will be. The bulls on the back foot to start trade. But hopefully by the end of it, they're going to go into the weekend with their dancing shoes. That said, let's focus on a few stocks on the broader markets. I thought Surbhi will highlight there. It's growing at least for now. It's up 3.5% in today's trading session. So good uptake is what we're seeing. Physics wala, yesterday I think the low was around 122 rupees. From there, the stock has seen a good recovery. Remember, there is limited float on all these stocks, but that one for now is up close to around 3%, and it's recovered all of yesterday's losses. So at least some green on that particular name. What's losing out? Hindalco. That's seeing some selling. And since there is some strength that we're seeing on the dollar index, which is at a 6-month high,
You have, LME-related names, aluminum-related names. Nalco as well is a little bit softish. I think you have NMDC that's a little bit soft. Even Tata Steel actually has seen some kind of profit taking just to kickstart trade. Other stocks that are in focus today, well, Lakshmi Dental, that's up close to around 4%, but volume's not very, very high on that particular name. While on the losing end, Hindalco's, yes, one of the top losers out there. But besides that, not too much to talk about. NetWeb is giving up some part of the weight that it put in yesterday. It's down close to around 3%. And you have JTL as well, that's down close to around 2%. Promoter has been buying, I think, more than 10 lakh shares in this week itself. AWL Agribusiness, 6.6% equity has changed hands. Vivek had alerted us. Likely to happen. Bang on. It's happened.
No, absolutely. And, lots of transactions and deals, etc. will continue. 1,600 stocks are lower and about 700 stocks are higher as we start. So that's the picture overall in that sense. We've, of course, addressed NetWeb once in a while. That's kind of the licensed player to sell NVIDIA gear in India and actually around Southeast Asia as well. That is down 3% after that big AI sell-off last night. But as somebody was pointing out, I mean, this TCS deal with TPG to build out the data center, that's the other side, right? Which basically shows that, and that's what I think the Persistent CEO was telling us earlier, the business momentum is there. And I mean, the story is absolutely right. But markets, of course, try to discount all of that now, and that sometimes becomes a problem. Too much upfront, perhaps. Keep an eye out on Reliance as well, because RIL was one of the big reasons why the market looked so buoyant, right? I mean, Wednesday's close was 15.18 or so. It closed at about 15.50 yesterday. This morning started lower, is recovered 10 rupees, 11 rupees already, RIL. So that's a big one, right, to keep an eye out on. Otherwise, I think the market breadth is slightly negative. It's still too early, nothing dramatic. Hindalco is down 2.5%. Some of the silver Bs is down about 1.6%. Supreme is down about 2% or so. So just kind of scattered kind of price action as we look at things at this point. TBO Tech on the upside. TBO Tech is coming up with about a 2.5% pop. There is Anupam Rasayan, which is up 2%. Rights is up 3% this morning. South Indian Bank is up about 1.33%. Saman Capital, it's coming up with about a 1% pop. Pretty violent price action last 3 days. But it's coming up with, it's the fourth largest volume-led gainer. So, in terms of volumes, it's the fourth largest. And so it's that's the reason why I'm mentioning it. Credit Access is up about 2%. So, yeah, there's enough and more which is coming up on our screens as we start this day. 60 points lower is what we have on the index, all told, with about 3 minutes into market open. Harsha Upadhyay is Chief Investment Officer, Kotak Mahindra Asset Management Company. He's with us here. Harsha, thank you very much for joining us. Characterize the environment, Harsha, if you will. Global markets have done so well that you're seeing a bit of a pullback. I think that's the simplest, maybe the neatest explanation. And I think that encompasses everything which is going into the mix there, right? As far as global is concerned. But here in India, there is optimism. One is this India-US. At some point, it has to happen. Timeline is unclear. And of course, as maybe people look for other things to do once, they say, well, maybe too much has gone on into this AI thing. So what do you think? Which way do the scales tilt?
Good morning, Prashant. As you rightly mentioned, I think global equities have done quite well over the last several quarters, and we are seeing a bit of pullback there. Yes, the global macro environment is somewhat different than what India is witnessing at this point of time. So I do not think that we should relate what's happening in the globe and take a cue from there for Indian markets. If you look at Indian markets, the influence of foreign institutional investors over the years has reduced quite a bit. As in earlier, whenever they used to sell in large quantities, market used to show a lot of downside volatility. That's no more true. That's point number one. Second, if you look at India in relation to globe or in relation to emerging markets, over the last year or so, we've seen almost about a 30% kind of an underperformance, which is very, very large underperformance. So to that extent, even if there is a pullback in global equities, I do not think that the current valuations of Indian markets warrant a similar move in Indian markets. And to top it all, we are also likely to see earnings improving over the next couple of quarters and also in financial year 27. That's the expectation currently. So given all of this, I would say that we may not participate on a one-to-one basis with what's happening in the globe of late. However, the upside also will be dependent on, as you rightly mentioned, some of the factors which could impact sentiment, such as a favorable trade deal with US, etc. Otherwise, it's going to be a reasonable market, much better than probably last 12 months. However, it's not going to be anything equivalent to what we saw between 2020 to 24, which was absolutely a phenomenal period for earnings growth, valuation re-rating, all of that. I don't think we should assume that kind of a market is going to come back anytime soon.
You know, Reliance, keep an eye, as I was saying, 15.55. So 15 rupees off the lows on RIL. And, you know, if RIL starts to perform, it'll basically make up for a lot of the other stuff, which may be going the other way at this point in time. Market's down just 40 points now, Surabhi.
Yeah, absolutely. I was tracking that. It's looking like the bulls want to fight back. Hi, Harsha. Great to have you with us. Let's talk tech. That's the conversation everywhere around the world, right? And even here in India, because now we've started getting some contrarian buys as well, citing valuations, citing, obviously the cash levels that these companies have, and then the moves that they're making, TCS being case in point, they're taking those steps on the data center front. How are you looking at the large cap IT services space? I mean, do you see it as a defensive fit in the portfolio, or do you think it'll just keep struggling at low single digit growth levels, so best to keep away?
Surabhi, I think you used the right set of words. You said contrarian buy. I think that's what it's going to be at this point of time. Yes, it has not participated in terms of market moves over the last 4 or 5 quarters. And now there seems to be some bit of a up move there. However, nothing has changed on the business momentum side. And still, some of the medium to long-term headwinds that are there for IT services, especially Indian IT services, still continue to be there. And as you also mentioned, the earnings growth trajectory for these companies is going to be much lower than average market earnings growth over the next 4 to 6 quarters. So given all of this, at best, it's going to be a tactical pullback that you will see at this point of time, or a contrarian purchase that you will see from certain market participants. But I would assume that non-IT services would be a sector or a segment to watch where there could be more outperformance rather than IT services itself.
So, sorry, just to complete that, when you say non-IT services, you mean other aspects of technology which are not traditional services companies. Is that what you're saying?
Yes. I mean, you can have selective investment opportunities in internet-based businesses where there are several businesses which have really scaled up well over the last couple of years. And also, as we forecast their growth over the next couple of years, we do tend to see a lot of growth in some of those companies on a bottom-up basis.
Yeah, Harsha, I'm glad you brought that. That's why I was just clarifying that if that's what you meant, because that was exactly my question, that IT services is not giving you growth. But now you have so many of these internet businesses coming, internet/digital these days, and every new business has a technology layer to it, right? You could be selling, eyeglasses, and there's tech there. You could be a broker, and then there is tech there. There's payments, and then there is tech there. So how do you slice and dice, and where are you comfortable with valuations? I mean, are the valuations still palatable? Because these are very fashionable stocks.
So I don't think you can, paint all of them with a single brush. While all of them use internet to do their businesses, the underlying business strength is something that you need to evaluate. Where there is a larger opportunity size, what's the kind of competition that you are seeing? Are there any entry barriers for a new entrants to come in? What kind of capital allocation some of these companies are doing? So I would say it's going to be purely bottom-up, even in the internet services. Just like what you see in traditional businesses, you cannot paint all the traditional businesses with a single brush. And same thing holds true for even internet-enabled businesses. I think the underlying businesses will determine to a large extent what kind of growth you're going to see in those businesses. And then there is an aspect of how good the capital allocation and efficiency that each of those companies bring in. So net, I would say you need to be selective even in that particular segment. And most of the valuations there are, of course, discounting some of the near-term growth that we are going to see. So it's not that anything is hidden in terms of valuations there. So you need to take a slightly medium to long-term call and stick with it and wait through volatility for all there is in those businesses.
Hi, Harsha. Good morning, and always good to see you in. Harsha, a lot of households, mine included as well, a lot of what you earn starts going into SIPs, into the mutual funds as well. And you're hoping for a brighter tomorrow, 10, 15 years down the line. However, in the near term, the issue has been the kind of supply that you're seeing. And appreciating good businesses is very, very good, right? Whether it's PEs, whether it's promoters, they have put in a lot of heart and soul and build those businesses. But when the kind of IPOs that are coming about, these sort of valuations, it appears that, they are exiting with the money, you're being left with the dream. What do you have to say to this? Because the kind of flow of paper that you're seeing, not in this year itself, but what is lined up even for next year, is very, very excessive. What's your take?
So, Nigel, even when the markets are doing well, there are several market opportunities on the secondary market which may not give you the same kind of returns as some of the others, right? So everywhere you need to be selective. More so in case of IPOs, because generally the offer for sale that's come from some of these IPOs is from either promoters or private equity investors, which means that they are the ones who know the business, they have run the business for quite some time, and they are coming and selling at this point of time. So obviously, knowing the business growth, knowing the internals of the company, they are offering their shares at a particular valuation. So that's where you need to be even more diligent in terms of evaluating some of those opportunities. And if you look at Kotak Mutual Fund, for example, we have been very, very selective in IPO opportunities. And that has worked for us. I think that's going to be the way that you will be able to manage the money. Otherwise, if you buy into all of the IPOs just because there is an IPO and there is an offer for sale, I don't think that's going to work. And if you look at the strike rate of IPOs over the last several years, I think these numbers are very clear and it's in front of you that the strike rate that you see in IPOs over a period of time is much lesser than secondary market opportunity. So definitely there needs to be more cautious stance on IPOs.
Okay, all right. What's the wisdom there? And I think we can all, do with a little bit of caution as well in that side of the market. Harsha, thank you so much for joining in. Good conversation as always. And we look forward to another one soon. Thank you very much. Well, with that, we'll move to our next guest. And as we do that, quick glance at the screen. Market is down, but not out. The bulls are trying to fight back. We're just about 35 to 40 points lower on the Nifty at this juncture. Look at that. There was a tinge of green on the Nifty as well while we were speaking with Harsha. But now there's some selling. So interesting Friday morning playing out. But for the time being, we're putting the spotlight on the real estate space. And we have Mr. Ashok Kumar Tyagi, MD of DLF, joining in. Sir, so good to have you in. I mean, always wonderful to get perspective from you on the business and on the overall market. So, a couple of things that we really want to focus on are key talking points, so to speak. Obviously, we want to get an update on the guidance because you've done very well in the first half. So we need to see, how strong those demand trends are, the bookings target and the launch pipeline. So let me start by understanding your sense of demand in your home turf first, at your home turf, the NCR market. It's been a very good first half. You are already at 70% of your guidance, I think 70% plus. What are you expecting in H2? What is the consumer telling you?
Okay, so 2 points will be. Good morning. One is, as far as the consumer is concerned, I think the underlying demand for, I'd say, the more credible developers and the more credible products is there. I don't think there's a slowdown there, frankly. Yes, obviously, whatever you read in the papers in terms of, challenges, etc., going forward, I do believe, in fact, if I were to borrow a line from your conversation with your last guest, a tinge of caution is not a bad thing. But I believe that maybe some of the fizz may gradually start slowing down. But for the underlying, the credible guys, the 5 or 6 players who are, I think the underlying demand continues to be strong. As far as we are concerned, we had guided the market to a sales pipeline of ballpark 22,000 crores, 20 to 22,000 crores for the fiscal. We stick to that. So, I mean, we know we have done 15,000 plus in the first half. But, much as we would like it to be, this unfortunately is not like an auto assembly line where, every day you are launching something. So I think we would, for now, at least stick to our originally guided pipeline, launch pipeline for this fiscal of the ballpark 20 to 22,000 crores. Over the medium term, in fact, in March, we had come out with a five-year guide plan. And I think we have a pipeline of almost 60,000 crores of products lined up for potential coming to the market in the next 24 to 36 months. And all of them will gradually come subject to approval, subject to how the demand is shaping up. So I think we are by and large, we have defined our grid rails, and I think we should hopefully keep on having a reasonably good ride on them.
Mr. Tyagi, hi, good morning. Prashant here. It's been a while since you've been on the channel.
आपने बुलाया नहीं?
हमने बोला, हम तो बुलाते रहते हैं आपको. आप तकल्लुफ करते हैं, but I think उम्मीद रहेगी आप आएंगे, और आएंगे. But Mr. Tyagi, just a quick, I just want to get, we'll get to the launch pipeline, etc. I think you were at an investor conference and you've guided everything to the street. And maybe we can touch upon some of that stuff. But since you're coming on after a while, how's the consumer in your sort of core market holding up? I mean, is it as strong as it was when we used to speak 6 months, 1 year ago? Is the absorption as smooth? Just wanted to get some color.
So okay. So Prashant, I mean, to the point, in fact, to just supplement the reply that I gave Surabhi just now, I think, as I said, the major or the more credible players, where the customer has an underlying belief that these guys will deliver the products to the quality specs, etc., that they have committed. I think the demand, at least in the NCR, at Gurgaon definitely, and I think even in Noida, continues to be underlying strong. So what happens in any bull market, even in real estate, is that at times some of the non-serious players, for want of a better word, get on the ride. And I think over time, maybe some of them will start feeling the slowdown in terms of their specific thing. But I don't believe that for the more credible players, there is a challenge right now. Obviously, one needs to be sensible about the product. One needs to be sensible about pricing. One needs to be sensible about the location. But I think given the fact that at least for us, we have most of those things lined up pretty neatly, I think we don't foresee a demand slow down in terms of what we bring to the pipeline. We bring to the launch pipeline. We'd obviously need to be sensitive to the fact that you can't launch 50,000 crores in a quarter. In that sense, that will obviously be far more than what the market can absorb. But as long as there is a certain degree of interval between what we are launching and there's a certain degree of upgrade stroke variation in what we're offering to the market, I think the demand continues to be good.
Right. So like to like, everything else excluded for DLF, the environment is same. I mean, you are a credible player. You're the oldest player, perhaps. There's no difference. Or there is some volatility in terms of absorption, because as you said, non-serious players maybe overbuilt. There's too much maybe supply. They've, in some ways, at the margin, spoiled the market. I mean, are those things affecting you in any way, pricing-wise or volume-wise?
So the simple answer is no. I mean, the last major launch that we got to the market was, the Privana North, which did extraordinarily well. The resale market, which I've always maintained is a very secular indicator of how the market is going on, continues to be very bullish and very strong, at least in our micro markets, both in terms of the demand for new transactions happening, as well as the price points and the price accelerations there. So I think the secondary market continues to be strong, which leads us to believe that I think there continues to be underlying demand for good primary products.
All right. Hi, Mr. Tyagi. Good morning. Good to see you in. It's been a while since we chatted as well. But let's get a couple of aspects out of the way then. The rentals. You have the completion of some retail projects, right? Midtown Plaza, Summit Plaza, Goa Mall. How do they aid rentals? If you could help us out with that. I think you all were talking about exit rentals in FY27 of around 400 crores. If you could just reconfirm that number. And also your balance sheet is in fantastic shape. I think you're sitting on close to around $1 billion. How will you be using this for expansion activities? Is there a sweetener you're going to be looking to give your shareholders?
Okay. So, Nigel, let me reiterate that when my communications guy told me that you will be one of the anchors, I had to go through my numbers because knowing your posture for numbers, in that sense. So anyway, so the three malls that we are very close to completing, one in Golf Course Road, one in Midtown in Moti Nagar, Delhi, and one in Goa. You're right, should ballpark on a full throttle basis have a rental in excess of the number that you mentioned. Our overall rental run rate fiscal 26 exit should be in the range of 6,000 crores and fiscal 27 should be in the range of 7,000 crores across Cyber City, the DLF rental projects, as well as Atrium Place, which is our joint venture with Hines. So I think the rental space continues to be very strong. Our vacancy levels are in the mid-90s. In that side, our occupancy levels are in the mid-90s. So I think the rental space continues to be strong. We are focusing more on the retail piece also now. There is a bigger retail project coming up in Gurgaon called Mall of India Gurgaon, which should hopefully in the next 3 odd years, see completion. So I think that's what the ballpark, sketch of the rental business is.
Mr. Tyagi, so we'll come to the cash as well, but given your big portfolio, malls, commercial spaces, you don't want to do a REIT? REIT guys have been doing very well and attracting a lot of investors as well.
So yes, in the last, I'd say, couple of quarters, the REITs are doing well, which is wonderful because I think it's a very interesting product. Mm-hmm. We have been very clear, Surbhi, that we are not pro or anti-REIT or pro or anti-IPO or anything. But we have no intent of taking Cyber City to the public markets till such time that our partner, which is GIC, wants us to. I mean, as and when they believe that there is a requirement for them to sort of guide us to move Cyber City to the public markets, we'll be more than open. That's an agreement that we have with them. But where we are today, frankly, especially with two very major projects underway, one in Gurgaon and one in Chennai, we don't believe that at least the next 3 odd years is the time for us to go public there.
Okay, so no REIT at least for the next 3 years. Now, quickly, Nigel's question on how you'll use that cash, 7,000 crores plus. And also, since the first half has been strong, and you remain optimistic on your business at least, will you revise the guidance, which is currently at 22,000 crores?
So the answer to the second one is no. We won't revise the guidance,
Why are you already done 70% of that guidance? So why are you not hiking it higher?
This is not a linear business, in that sense.
True.
So whether we can get all the requisite tools, etc., for the next big launch before March. So I think right for now we'll stay with the guidance that we have. To the cash question of Nigel and you, I mean that's the only side which we have been very transparent in our analyst presentations. That yes, we are sitting on 7,700 odd crores of net cash position, which frankly is increasing by almost 1,000 crores plus every quarter. The issue today is that if you look at our presentation, almost 8,000 crores is today locked in the 70% RERA account. I mean, so yes, the cash is there, but frankly, as we speak right now, the cash is only generating FD returns, and that is all that the cash can generate. We believe that from the early part of the fiscal 27-28, we'll enter that virtuous cycle of this generation of projects hitting their completions and the cash being released. So, to your question of what to do with that additional cash, I think is a question that we will answer then. We have broadly said that the cash will be used for essentially two things. One is clearly increasing shareholder returns, which we have been increasing at a certain pace over the last 4 years. B is investing back in growth. And C, frankly, if hopefully we will have surplus cash, we will see how we can also, increase and maximize the returns once we have no constraints of the RERA 70% account.
All right, Mr. Tyagi, can't let you go without asking you which part of the cycle we are in the real estate cycle.
The pessimists are saying very close to the end, optimist, and you're sounding very optimistic. They're saying we're at the start of it, just day one of the 5-day test match. Where are we?
So, I mean, what is bilkul data backed is that we are, I think, in the 4th year of the upcycle for sure.
And the upcycle is 10 years.
No. So there, I think, I'd say I would desist from taking a guess. 7, 10, 15, 18. The only thing that I'd say is, Nigel, that unlike the last down cycle, if and when the down cycle comes, and you're right, at some stage it will, most of the grade A developers are virtually completely deleveraged today versus the situation 10 years back when most of us were saddled with leverage. So I think all of us are hopefully far better equipped to handle the down cycle as and when it comes.
Okay, all right, Mr. Tyagi. Always a pleasure, sir, speaking to you. Thanks a lot for the compliment as well. I'll keep at the numbers. Thanks for joining in, giving us the guidance. You're sounding optimistic. Year 4 of that real estate bull market cycle that we've seen. We chat up soon and wish you all the best with the new launches as well.
Thank you.
All right, time to slip into a short break. On the other side, the management of Metro is waiting for us. They'll give us the outlook for FY26 as well as they'll give us the demand trends as well. Welcome back. Well, as promised, let's get chatting with the footwear company Metro Brands. That's in focus after launching Metro Active, a new brand of stores focused on athletic footwear. We're joined by Mr. Nissan Joseph, the CEO at Metro Brands. Hi, sir. Good morning. Always good to speak to you. Well, the top talking points that we're looking at is how are the demand trends in the Q3 so far, the transition after the GST rate cuts as well, how are things panning out, and the new offerings and the store launches. But let's get to the recent announcement then, sir. You have announced the launch of Metro Active. That's for athletic footwear. What kind of expected revenues you're looking at, the kind of expansion plan that you've seen? Clearly, there's a big potential out there, and you have launched in select cities. But I'm guessing in the next few years, you'll have a plan, maybe 3 years down the line. How big can this become?
Yeah, well, I think let me get started and talk about the positioning of Metro Active. It's very much designed for a performance seeker, and it's for people that want to get active. And activity is really an individual-based criteria. Whether you walk 1 kilometer or you run a triathlon, this store is for you. Whether you play pickleball or you play squash, whether you play cricket or you play soccer, this is for active people, and that's hence the word Metro Active. We carry some of the world's best brands when it comes to athletic brands, such as Nike and Adidas and Puma and so forth, and we also have ASICS. So these are some very, very well-curated brands that are best in class for athletes in different sports. The stores are going to be ranging around 3,000 square foot. They cater to men and women, and they carry a small offering of athletic apparel to go with your workouts, right? So the whole idea is to engage the community in getting active, and whatever level of that might mean. We've opened our first store in Indore. We're getting ready to open our store in Dehradun, followed by Jodhpur this year. And early next year, calendar year, we hope to open in Surat and Nashik. As you can tell, we're targeting really underserved communities that have a huge growth in athletic participation. So athletic participation is going to more than double in India in the next 5 years. That's just one data point. The other data point is, I don't think people know this, but there's over 700 races that happen in India every year. We all know the big four. We talk about the big four marathons, but there's over 700 races that happen in these towns that we believe is highly underserved in having access to products, access to information, access to knowledge, access to running communities and workout communities. So we want to create an entire ecosystem where we can help people get active.
Okay, all right, got that. But you don't have a ballpark number that you're looking at? Clearly big potential, but would you have a target as a percentage of your revenues, or if you want to put an absolute number out there?
Well, I think the percentage of revenues would be misleading simply because, we do plan on growing our Metro, Mochi, our Walkway banners. It's not like we're going to stop growing the other ones to grow this one, right? So this has some catching up to do, in an arena where everybody is pretty much growing on an accelerated pace. So, as you know, last quarter we opened 40 stores. We hope to see that pace starting to become part of our DNA. At the same time, we opened up another 3 Foot Locker stores in the quarter. So there's a lot of activity going on in terms of new stores. So I think what's more important is, we believe there are a lot of underserved communities like Indore, whether it's a Patna, whether it's a Hubli, whether it's a Dharwad. There are tons of these communities. There's tons of these cities where people need to have access to information and great products. So I think the opportunity is quite significant for us as we look long term. But it's part and parcel of the Metro Brands fleet of stores that we plan on continuing to grow.
Okay, all right. Let's focus on a couple of other trends then. How is demand being post GST implementation? Quarter 3 has been as good as you expected. And tie that in terms of what can you do for the year? First half of the year, you've done around 1,279 crores. Last year, you did ballpark around 2,500 crores. For this year, what is the broad range in terms of revenue?
Let me take it one step at a time, Nigel. And I love the way you corner numbers on people. But first things first, I think we're very pleased to see the demand trend that's happened that started in Diwali and has continued through the wedding season. As you know, we're in the peak of wedding season right now. And those trends have been very consistent with what we would expect, actually quite consistent, especially compared to the lumpiness of the 3 years. And I'm calling it 3 years post-COVID because, we had the revenge shopping, then we had the revenge eating out, then we had the revenge travel. I think we had the catch-up weddings. I can't call it revenge weddings, right? So all that created a shift in how consumers spend their money, where they spend their money. It was domestic travel first, then it was international travel. Now we're starting to see hotels in Goa fill up. Airfares are starting to get on the rise again, showing that what we are seeing is the consumers going back to spending money the way they used to spend it in allocations rather than in pent-up demands of different needs that they have. So we're very encouraged by that. We're quite excited about it, actually, to see us finally getting into a normal pattern of some sort. Having said that, though, we're going to have a slightly offset January because last year we had wedding dates in January. This year we don't have any wedding dates. That stuff's going to continue. But when I look at it at a broader trend, we definitely see demand as being on the uptick, as you've seen from our numbers in the last 2 quarters. The other thing is, the GST effect, I think, has had a positive effect for us, especially in our Walkway business, where almost 90% of their products benefited from the GST. But that doesn't mean Metro and Mochi were in any way not recipients of that. In Metro and Mochi, we see about 35 to 40% of our products that got positively impacted by the GST rate changes. So, we are seeing a lot of good things happening and a lot of stabilization in demand, which is very exciting for us.
So you are very confident on demand, Mr. Joseph. Quick word on margins as well. You're around, I think, that almost at that 27% mark right now. By the time we end this year, do you think you'll get to 30% as you've mentioned in the past?
Yeah, I mentioned it and, we're going to stick by it. Having said that, though, we are making some great investments right now, whether it's in marketing, whether it's on our new stores and so on and so forth, right? So we don't expect that to be in any way dilutive to that. But I also want to assure that we're not just doing it. We're not just running our business for the sake of hitting a number there and hitting that margins. We're going to hit those margins. However, we're also continuing to invest in our business, both from a people standpoint, from a technology standpoint, and also from marketing standpoints. As we raised our marketing spends over the last 2 quarters without it being erosive to our top line.
Okay, and just a quick comment on Fila, break even there. And also Foot Locker in terms of, the rollout that you are planning for the rest of the year.
Yeah, so I think Foot Locker, the BIS rulings that came in that limited the import of certain footwear products continues to have an impact on how fast we can open those stores. We're hoping that those issues start getting resolved in different ways, mainly by a lot of manufacturing shifting to India, but also, some factories getting certified abroad to bring in some of that heat product. But till we have a sense that that has settled down and we have good visibility of the supply chain, we're going to just keep that Foot Locker growth a little bit on the slower side, though we're still opening stores. We're going to open another store in Bangalore in this coming month. So it's not like we've stopped opening stores for Foot Locker. We're just being a little bit more cautious or a little bit slower than I'd like to be. And I think we'd have been a lot faster with that BIS behind us. As far as Fila goes, we are in the middle of repositioning for Fila. The repositioning is going to be about an 18 months to 24-month journey. So it's not as fast as I would like it, but you don't build brands overnight. And we want to build it right for the future. So we're not trying to rush it through. But on the flip side, we've seen some very good green shoots on some of the products we've launched, predominantly in our Metro Mochi stores. So we can get a good quick read as to how that positioning is coming across. But we're also excited to see that Fila is selling really well in Foot Locker and in both footwear and apparel. So there are some good early green shoots coming through, but I'm not going to, get out the party hats and start celebrating it. It's a road ahead, but that's how we do things. We're building it for the long term.
Thanks very much and for joining us. And I think for me, the number which stood out, 700 races in India. I didn't... 700, right? So
actually, Prashant, I was being a little conservative. I believe it's actually over 900, but I thought I'd go safe on TV.
Wow, that's some number. Thank you very much for joining us. Really appreciate it, and good luck as you continue to execute. Thanks very much.
Thanks, guys.
Okay, well, I think markets are down, 100 points, 26,100 is where we are at. We'll shift gears now and focus on Mahindra & Mahindra. M&M held its investor conference, and my colleague Shireen spoke with, the entire who's who of the Mahindra top brass, 14 CEOs and business heads on their plans for the next 5 years. Listen into a slice of this conversation.
Let me quickly go around the room, and Rajesh, I'll start by asking you vision for 2026 and the vision over the next 5 years. What do you hope to complete?
We can't call 2026 a vision. It's almost a budget. So, yeah, Shireen, we don't put out guidance, but we have this time to say that our businesses are going to grow multiple times in this decade, and we are very, very positive and optimistic on every business that we are in. The SUVs is doing very well, and there's a lot of upside. The LCVs as well, and tractors. We put out some specific industry numbers, and we stay very positive about the next.
I like the
next 5 years.
Industry-specific numbers.
Well, we're not going to lose market share, so we'll grow at least that much.
You'll grow at least that much. Mohit, I know, try and manifest a little bit
I'm going to put up the vision board. I think I'm going to put up the vision board. Look, I think we put out a very clear plan for FY27, right? At the time we put it out, candidly, most analysts didn't fully price for it because they said, look, this looks really, really difficult in terms of margins, in terms of growth. But over 6 quarters, we have demonstrated resilience and performance towards the goal. So if you think of it, as a plane, we were taxiing, now the wheels have left the ground, and beyond FY27 is the time to go supersonic.
Go supersonic. You're going straight from taking off to going supersonic, and perhaps that's the best segue to come to you, Vinod. How quickly do you believe you can go supersonic with your business?
So, Shireen, as Anish said, we are sitting on a huge order book right now, which we have won in last 1.5 years. And the priority for F26 is very clearly to industrialize those packages, which in this industry takes a couple of years. And once we industrialize, then the revenue starts kicking in. And the most important thing which we are right now doing, which we are actually paranoid about, is that we are on one hand, we are delivering the orders which we already have executed. On second hand, we are doing industrialization. And we have to do both very, very well without losing the reputation we have built. And that's clearly is our priority for 26.
That's the priority. Manoj, of course, Signature Resorts, I would imagine, is going to be the key priority as well as the key ambition.
Yeah, so of course we are in a growth market. So I think Signature Resorts is one new foray which we have articulated. But really, I think scaling the core to 10,000 keys, I think that remains a big priority too. And as we think about it, I think whatever we have put as a decadal vision, it really translates to double the keys, double the revenues, and triple the profits from here on in the next 5 years. So I think that's the way we think about it, that we really have to focus on both of these. And of course, Signature Resorts is the new initiative. So obviously, it will take a lot of time and attention, but scaling the core remains important too.
Nal?
F26, I have a must-do target, Rajesh said he. So we have to do mid to high teens growth in our SUV portfolio and high single digits and not lose share in the LCV portfolio. But over the 10-year period, we have a 8x target in terms of revenue top line for the auto business.
8x target. Amit?
So we have F27. We are pre-sales 4,500 to 5,000 crore. We are at 2,800 crore, so significant jump. For F30, 10,000 crore sales, which we'll try to accelerate sooner, which will be over a period of decade, will be 14x from where we were in F20.
Vijay?
Well, I think the focus will be on 4 growth vectors. Create a fortress around our domestic business, scale up international, scale up farm machinery, pioneer technology. Do all of this to deliver a 3x growth in revenue and meet our aspiration of impacting farmers' lives globally by pioneering technology. And do this through think big, do less, and execute flawlessly.
Suman?
Over the last 3 years, we have delivered 5x EV volume growth and put 300,000 EVs on the market. Our aspiration is to close the decade with 1 million EVs on the market.
Okay.
So that's across all the categories.
Across all the categories, 1 million of EVs on the road. That is the aspiration and the target as far as you're concerned. Avinash?
I think it's execute well on the projects that we've already won. Focus on winning new bids, especially more complex ones that are able to deliver peak power using batteries. And then ensure that the projects that we have built focus rigorously on quality and then recycle capital so that they can go back into new projects.
Rahul?
I'll draw from Anish's slide today where he positioned TechM and Mahindra Finance under unlock full potential. So clearly there's a pivot to growth. I think that growth will be on a couple of pillars. Number one is defend our vehicle business. Number two is grow our fee-based income. And number three is build adjacencies in mortgages and SME.
Okay. Amar, which is going to be the most crucial metric that you're going to be watching closely and chasing after over the next 5 years?
I think for us, the growth momentum is there. I don't think that's going to be, I think Anish already laid out a 15 to 40% growth metric across all our businesses. So the growth metric is there. I think the profitability and the ROE must stay to what has been committed externally, the 15 to 20% growth in EPS and the 18% ROE commitment that we have made, because that's the discipline that will make. For me, the big thing going into the 30s is going to be there are a lot of Indians who are admired for being CEOs of big global brands. We want Mahindra to be the Indian brand that's admired globally. Right? And I think that will all come from all of this that you've just heard today.
Well, Anish, the pressure is clearly on you.
The beauty here is the leaders we have here are absolutely incredible. And therefore, that makes it much easier. We are building on a very strong foundation. And we've done well over the last 5 years. As we look ahead, to summarize what some of the leaders have said, we presented to our investors our growth over this decade from 2020 to 2030. We are halfway through that. For this decade, SUVs 8x in revenue, LCVs 8x in revenue, ILCVs 6x in revenue, electric three-wheelers 6x in revenue, Mahindra Finance 5x in assets under management, Susten 5x in installed capacity, Aerostructures 12x in revenue, Lifespace is 14x in pre-sales. We're thinking of growth in multiples, not in percentages. And profit growth will be higher than revenue growth, and market cap hopefully will be higher than that.
All right, that is Mahindra and Mahindra, their entire top team laying out business plans, strategies, and their ambition for the coming few years across the businesses, multiple businesses, and the stock is doing really well. Okay, let's get to Chandan Taparia now to understand some trading cues for the day. Chandan, thank you for joining in. So we started with a bit of a, a gap down, small gap down. But the question is, do you buy the dip? What would your trading strategy be?
Yeah, good morning. Thanks for having me. So major trend of the market is positive. In fact, on the last trading session, we just missed the lifetime high by few points. Our index headed to us 26,250 and lifetime high is 26,277. So market is absorbing supply near its all-time high, and that is a good sign. Today it's down, but I believe till it holds above 25,850, buy on decline could continue for an upside move towards all-time high of 26,277 and a fresh rally towards 26,500. So buy on decline could continue as of now. However, one interesting thing we have noticed today is India VIX is up by around 8-9%. In fact, it headed towards 13.3 marks. So surge in the VIX is the reason that the market is finding some pause, but overall buy on decline could continue as major trend of the market is positive. Now talking about Bank Nifty index, here the trend is positive. In fact, Bank Nifty has been making all-time high from last few days. Till it holds above 58,500, buy on decline could continue for an upside target towards 59,500 to 59,750.
Okay, all right. 100 points down on the Nifty for the time being. What about individual stocks? What are you working with today, Chandan?
Yeah, so positive on the Nifty auto segment. This is one of the strongest counter, which is all set to give a consolidation breakout. And here we are picking buy on Eicher Motor, one of the strongest counter, which has given a consolidation breakout of last 8 to 9 weeks. It has been making higher top, higher bottom on the daily chart. In fact, the longs are being added, and the counter is expected to witness a rollover of more than 80 to 85%. So recommending to buy on Eicher Motor with support of 69.50, and this counter has potential to rally to a 74.50 kind of level. Second trading idea, that is buy on GMR Airport, strongest price pattern. Counter is trading higher than its volume weightage average. In fact, we are witnessing put writing at 100 strike. Call unwinding started to witness. Short covering is expected in the counter. So in fact, technical wise, we are witnessing a bullish implication of pole and flake pattern. So recommended to buy with support of 102 for an upside target towards 109 level. So two ideas, one is Eicher Motor, second is GMR Airport. And apart from that, bullish stance on the Nika as well. One of the strongest counter, which has been consolidating from last 3 days, but trend is positive. Derivatives data indicates bullish stance. So one can buy with support of 263. And here we are looking for an upside target towards 282 kind of levels.
Absolutely. Thanks very much for that. We're going to take a quick commercial break here. Markets are down about 100 odd points. We'll come back. Manisha will take you through what's happening on the commodity space. Coming up.
Welcome back. Well, we've told you about the equity picture where the market's still down about 100 odd points. Let's figure out what's the latest in commodities. Manisha is with us with the latest. Manisha, what's catching your eye?
Oh, the crude oil prices, because we've seen constant decline into this one, and we are back yet again below that $60 per barrel mark for the U.S. crude oil prices. Well, we are trading at a 4-week lows when it comes to the crude oil prices, and we are headed for a weekly decline as well. When you look at the U.S. crude inventories, well, that has been one of the major reasons that is putting pressure on prices, up 4.4 million barrels, and this is a third weekly gain that we are looking at in sense of U.S. inventories. Remember, the U.S. inventories have been climbing. The U.S. production is near all-time highs as well, and that continues to put pressure. China, in the meanwhile, even as there are refining maintenance is happening, but China is continuing to stockpile crude oil prices as and when they go around that $60 a barrel mark, building reserves. So markets do believe that going forward, China perhaps may need so much crude oil because they are stockpiling right now. Apart from that, the Ukraine president signaling move towards a peace talk. We know the details about that. We've been talking about that. That's yet another reason that the markets feel that the Russian supplies may not get disrupted, and some of those sanctions perhaps will go away as well. But for today, it is about sanctions on Russia's Lukoil and Rosneft, and markets believe that that could leave nearly 48 million barrels stranded on sea. That's a lot of crude lying around there, and that also isn't a reason that you would buy around in sense of crude prices right now. And then let's talk about India, where we're looking at import bill declining by 13% between April and October at around 71.2 billion. Well, the data suggests that the imports have not declined, but it is the crude oil prices which are down by nearly 15% from where they were in the previous year, and that really seems to have made the difference. The import reliance, also as per the latest ministry data, shows that India's import reliance stands at 80.2%. Interestingly, also when you look at India's domestic oil production, well, there has been a decline between the same period to the tune of 1.2%. Interestingly, there's plenty happening in the international markets when it comes to India as well. Latest with Reliance saying that they will comply with the European Union in sense of import of products derived from Russian oil. So that really seems to be making a change there. And then apart from that, there also have been various statements from Minister Puri suggesting that India's PSU oil companies will sign a one-year term deal to import nearly 2.2 million barrels of LNG from US. At this point in time, with the kind of deal that has been done and the import India is doing, that accounts to nearly 10%. And then India's crude oil imports from US also seems to be rising. For the month of October, we've seen a neat 540,000 barrels per day come in because of that as well. Take a look at the price moves then. And for the crude prices in this year, we started this year with $75. We saw a high of 82, and then we've been languishing near the low of this year currently as well. If you look at the crude oil prices, the last 3 years have been in the negative. 2023 was a 10% decline. Last year was 3% down. And this year we are down by 18%. Not just that we are down for the third straight year, but we are the lowest in 3 years that crude oil prices have seen in sense of averages there. Next year as well, it's expected that you could be looking at surplus going forward, and that comes in anywhere between 1.5 to 4 million barrels per day, often expectations coming in from OPEC, IEA, World Bank, etc. The price moves in the next year, well, that really seems to be divided, but most people seem to be believing that it is going to be anywhere between $50 to $68 a barrel. That is where overall gets summed up. The lowest coming in from the IEA, Goldman Sachs, which are talking about mid-50s, but you also have Morgan Stanley, Citi talking about early 60s, and then mid-60s yet again coming in from Bank of America and World Bank. So the range that we've seen this year perhaps could be a range next year as well, but pretty much on the lower side.
Okay, all right, Manisha. Thank you very much for that. That is as far as the oil markets are concerned. By the way, before we hand it over to Lata, news is just coming in from Japan, and it's big news. That stimulus package that markets have been awaiting in Japan has finally been announced. And guess what's the value? Hold your breath. $135 billion. And this includes subsidies on electricity bills, a lot of additional new grants, and so on and so forth. So this is pretty big. Measures for the shipbuilding industry. Lots happening over there. This was widely anticipated with the new leadership coming through. So we'll watch out for whether it has any bearing on the market or not. Right now, the Japanese market is still down about 2% Let's take a break on that note, come back on the other side, and we'll have our special segment, It's the Economy. Lata speaks with Nomura economist Aurodeep Nandi on volatile global markets and the impact on rupee and growth.